My name is Yale Simpson. I'm the chairman of Exeter and the founder of the company with Bryce Roxburgh, the CEO. The pre-feasibility study we just did was the first part, or the first of two pre-feasibility studies. And this is one that we call it the Oxide Pre-Feasibility Study. And the specific purpose is that the oxide deposit is if you like, a younger deposit without copper that sits on top of the main gold-copper resource at depth. So when you look at the total resources that we quote for the project, and if we just look here at the measured and indicated, which are the two categories at a higher level of confidence, there's approximately 1.4 million ounces of gold, like I said before, that is without copper at surface. And there's many mines around the world developed on such deposits. We call them oxide gold deposits. And so we wanted to look at that resource and say, could that resource be developed by anybody at any time, including Exeter, as one option going forward? And the idea was to get the study in the bag, but be doing it commensurate with the bigger study. So it's not moving away from the bigger study at all. The purpose was simply to say, what value is there in simply the upper deposit? Because that deposit could be mined much quicker. It takes far less engineering, far less infrastructure costs. It's a sort of project that, given the scale of Exeter, that Exeter could contemplate building. You wouldn't necessarily need a partner. You wouldn't be looking at any of the bigger options. We could do it. So the purpose was, let's have a look at the economics of the Caspiche Oxide deposit. As I said, the resource is approximately 1.4 million ounces of gold, and there's about 5.4 million ounces of silver accompanying that gold in the oxide resource. What the engineers who worked through this, and I'll say the engineers were Jacobs Engineering, a major engineering firm out of the United States. Their Santiago office did this study. They looked at the kind of options going forward and said there's three ways that you could develop the oxide. But in the end, they focused on one, which was a 5-year project to mine all of that 1.4 million ounces within 5 years. So the specific outcomes are, given the recoveries you get from oxide projects like this, the mine would produce on average 210,000 ounces of gold a year and 365,000 ounces of silver a year for 5 years. So we're looking at a 5-year mine life. The cash cost of producing that gold, net of the silver credit, because the silver would be sold and then you're onto the gold, is $524 an ounce. And and looking at gold today at $1,500 an ounce, that at $524 an ounce pretty much falls in the bracket of the average operating cost for similar projects in the industry. Now, what is the internal rate of return? Quite good, 34.4%. What's the payback period? 3.2 years on that project. So the capital required to do it is about $335 million. And that's quite a lot of money. And I'm going to talk a bit about how it's broken down. But we're looking at mining 62,000 tons of ore a day over this 5-year period, and a relatively small amount of waste. The waste-ore ratio in this project is about 0.2 to 1. So looking at this project, it's a pretty good project. In fact, many companies of Exeter's size would proceed to build this project. Now, we haven't taken that decision yet, but we're moving down that path. Just another parameter for it. You say, what gold price did you use in this study to come up with your economics? We used $1,320 an ounce gold, and we used, I think, $25.80 an ounce for silver. So this project that's pretty much the parameters. There are many ways to start optimizing this kind of a project. In other words, this is a pre-feasibility study, and typically a pre-feasibility study is followed by much more detailed engineering, which would lay out a number of the parameters. But when you look at the cost structure, people say, how do you come up with this capital cost that you did? Approximately 40% of that relates to building the plant itself. But there's about $80 million of that project as well is related to simply bringing in the water and the power required for the project. And that's a lot of money. And the interesting point is, and I was asked this question, I think the day we put out the press release, was how much of that equipment would you use for your sulfide project that would follow? And that's a really significant question because the water, the power, those are things you need for the bigger project anyway. So there's quite a lot of flow on. There's a lot of residual value in this project that could flow on to the larger project that would come later. The major sulfide study, and let me define that more exactly. We're looking at the oxide project, and that's what I've just spoken of. The bigger project, and we call it the sulfide project, it really is a combination of mining the oxide, then the sulfide, and the total cost of the combined entity. That's what we call the oxide sulfide project. Now, as I said, the sulfide deposit underneath the oxide zone carries almost 90% of the total amount of gold and, of course, all of the copper. So that is really the prize. The major study we're approximately a little bit past halfway through it. The major study is due to come out at the end of the year. And so we are continuing to do various work outcomes for it. Those programs, apart from the pure costing of the exercise, determining how many trucks, determining all the critical equipment parameters. Yes, that's one aspect of it. But the other part is to say, what is the best way, for instance, to move all the material? You can go with a big fleet of trucks, because remember, the trucks are dominated by what is the amount of waste and the amount of ore, because for every ton of ore, you have typically, and it depends on how we in fact go about mining this project, but you could have 3 to 4 tons of waste for each ton of ore. So how are you going to move all that waste? Where are you going to put it? So one of the studies that's part of the pre-feasibility study is a study on replacing many of these trucks with a conveyor system. And that conveyor system is often used in the biggest mines in the world. It certainly drops your operating cost down because it's easier to operate a conveyor belt, or cheaper I should say, than it is to operate a truck. And the other benefit is from an environmental point of view. Your environmental point of view is significantly diminished if you're operating fewer trucks, fewer fuel, fewer emissions. So that study is just one sub-study within the major study. So the total oxide plus sulfide project pre-feasibility study is due in the last quarter of 2011. When we look at the value, and I referred to at the beginning of the oxide study, we came up with a net present value, discounted net present value at a 5% discount of approximately, I think it was $330 million. Now, when you look at the combined project, you're combining that oxide with the bigger one. Now, when we undertook the oxide study, we didn't know, in fact, what the outcome would be. And we've got a good project with that outcome. So doing the sulfide study in combination with it, we're then in a position to demonstrate to our investors, to the market, just the amount of ore that can be mined daily, the total gold outputs. We can't tell you today how much gold would be mined annually in this deposit yet. It's taking 22,000 man-hours of engineering that we're going through to define these outcomes. But given what's happened on the oxide, the company is most optimistic that when we wrap together the oxide and the sulfide, we'll show the real value of the project. The real value that you can't define simply by announcing how big the resource is. We've done that. We did that in September of 2010. Now let's show what the real value is to develop the asset. And we are optimistic that value will be considerable.